Picture a day when the stock market is plummeting, panic on the trading floor, retirement accounts shrinking, and yet a small group of investors is actually making money while the market crashes. To understand how they do it, we have to look at the normal rules of investing. Usually, the math is simple. You buy something at a low price and you hold on to it until you can sell it at a higher price. That rule means you are tied to the direction of the market. When the overall economy takes a hit and prices drop, the value of what you own drops right along with it. But there is an exclusive tier of finance designed to bypass this requirement. They use specific strategies to break the normal cycle of buying and holding. While everyday investors are often trapped by the unpredictable weather of the stock market, this exclusive tier is built to keep moving forward regardless of which way the wind blows. This is the world of the hedge fund. Simply put, a hedge fund is a massive pool of money collected from highly wealthy individuals. Instead of managing it themselves, these individuals hand their pooled money over to a specialized expert called a fund manager. This manager doesn't just buy a few stocks and hope for the best. They actively design complex strategies to find opportunities that most people miss. Their only job is to beat the market. They are hired to find a way to walk away with a profit, whether the overall economy is going up or down. One of the main ways they make money when a price is falling is a strategy called short selling. It sounds like technical jargon, but it's actually a very simple transaction. Imagine you borrow a brand new $1,000 VR headset from a friend. You don't own it, you are just holding on to it for a while. Now you immediately sell that borrowed headset to someone else for $1,000. You now have $1,000 in cash, but still owe your friend one VR headset. Now you wait. A few weeks later, a newer model comes out, and the headset's value drops from $1,000 down to $600. You take $600 out of your cash and buy the exact same model of headset back at this new lower price. You return the headset to your friend. Your debt is settled, and you're left with $400 in profit. You still followed the rule of buying low and selling high. You just did it in reverse order, so you could profit from a price that was dying. While this sounds like a perfect plan, it is an incredibly dangerous game to play with millions of dollars. Think back to that headset. What if, instead of the price dropping, the headset became a rare collector's item and the price suddenly shot up to $2,000? You are still legally required to return that item to your friend. You would have to buy it back at the higher price, no matter the cost. If the price keeps climbing to $10,000 or $20,000, the amount of money you could lose has no ceiling. Because the danger of losing everything is so high, government regulations generally only allow the extremely wealthy to put their money into these funds. Hedge funds act as gated communities. They are restricted to those who have enough extra capital to survive a catastrophic loss without being ruined. At their best, hedge funds serve as a financial shock absorber, designed to handle the bumps of a volatile economy. Whether the market is going up or down, the goal of a hedge fund is to profit in any kind of weather. If you want more simple explanations of the complex systems that run our world, follow the Teaching Fish and subscribe for more. Understanding these hidden mechanics is the best way to make sure you aren't left behind by the broader market.